and welcome to Ticker Tapes. Today, we're back in the world of ETFs. Global markets have gone into reverse once more as fears about rising inflation and the pace of interest rate rises take center stage again. The S&P 500 has fallen by more than 10% in the last 5 days of trade. The Nasdaq 100 lost 11% of its value and is now down by 30.69% year to date, compared to a fall of 21.6% in the S&P 500. Against that background, very few ETFs have performed well, and those that have are either designed to prosper during periods of market turbulence or are uncorrelated with equity indices and the wider market. No surprise then that TAIL, the Cambria Tail Risk ETF, gained 6.06% as equities sold off, whilst BTAL, the U.S. anti-beta market neutral quant shares ETF, rose by 7.48% over the last week. The best performing funds, however, were those that are linked to interest rate changes, such as PFIX, the Simplified Interest Rate Hedge ETF, which rallied by 17.84% over the last week. The fund is designed to hedge interest rate movements and to benefit from an increase in interest rate volatility, which we are certainly seeing right now. In hindsight, the ETF looks to have been a decent bet for the year to date because its share price is up by 71.76% in that period, and only a few energy-related ETFs can claim to have performed better so far this year. However, some of those same energy ETFs sold off this week, with UNG, the U.S. Natural Gas Fund, falling by 22% as news broke that a Texas gas processing plant damaged by fire could be up and running again in 90 days, much quicker than the market had been anticipating. Turning to flows, the switch out of SPY and into lower-cost alternatives that track the S&P 500 appears to be continuing, with more than $8.3 billion of redemptions being made from the world's largest ETF in the last week. A large chunk of that money, $5.11 billion to be exact, appears to have been reinvested into IVV, the iShares Core S&P 500 ETF, with another $4.6 billion finding its way into VOO, the Vanguard S&P 500 ETF, as well. $526 million flowed out of XLF, the Financial Select Sector Spider Fund, which might seem counterintuitive as banks and other financial institutions usually do well in rising interest rate environments. However, high inflation erodes the value of the loans and other assets they hold, and with inflation running well ahead of interest rates, banks could, in theory, be making negative returns on some of their assets. Finally, though things have looked quite bleak for equities in recent days, they have at least outperformed cryptocurrencies, some of which appear to be in a complete meltdown. That's been reflected in the performance of the Grayscale Future of Finance ETF, which invests in crypto and blockchain-related stocks. The fund fell by 21.73% over the last week and is now down by 46.18% since it launched some 3 months ago. What's more, the ETF is now trading 61.5% below the high point of $29.20 posted on the 29th of March.